Everyone wants a safe investment, something stable, predictable, responsible, something you can put your money into and finally relax. But here's the uncomfortable truth. Most people don't lose money chasing risky investments. They lose money misunderstanding safe ones. And the mistake is so common that it feels normal. Let's expose it. When people say safe investment, they usually mean one of three things: savings accounts, fixed deposits, bonds, or maybe real estate in a good area. The logic sounds solid. No wild swings, no scary headlines, no dramatic crashes. But safety is not the same as security. And this is where people quietly fall behind. The first mistake is confusing stability with growth. If your money is sitting in a place that earns 3% while inflation is running at 6%, you're not staying even. You're shrinking. Slowly, invisibly, politely. It doesn't feel like a loss because the number in your account isn't going down, but purchasing power is. And over 10, 15, 20 years, that gap compounds against you. Safe from volatility does not mean safe from erosion. The second mistake is ignoring concentration risk. Many families put the majority of their wealth into one safe asset, usually property, a house, maybe two. Real estate feels tangible, solid, real. But one market, one city, one asset class, that's not safety, that's exposure disguised as comfort. True safety often comes from diversification, not familiarity. The third mistake is believing guarantees eliminate risk. Fixed returns feel reassuring. Government-backed products feel untouchable. Insurance-linked investments feel protected. But every investment carries risk: interest rate risk, inflation risk, liquidity risk, policy risk. You might not lose the principal, but you can lose flexibility. And flexibility is financial oxygen. Here's the deeper issue. People choose safe investments emotionally, not strategically. After seeing market volatility, they retreat to what feels calm. After hearing horror stories, they choose predictability. After experiencing uncertainty, they prioritize comfort. And that's human. But comfort is expensive when it replaces strategy. Now, let's be clear, safe investments are not bad. Emergency funds should be safe. Short-term goals should be safe. Money you need within 2 to 3 years should not be in volatile assets. But long-term wealth cannot grow in low-growth containers. If you're investing for retirement 20 years away and everything you own barely outpaces inflation, you're not being cautious. You're being quietly aggressive against your own future. Here's the mistake most people don't see. They treat all their money the same. Instead of giving each dollar a job, your emergency fund's job is stability. Your opportunity fund's job is flexibility. Your long-term investment's job is growth. When you force growth money into stability assets, you sacrifice compounding. And compounding is where real wealth is built. Let's put this into perspective. If you invest $10,000 at 3% for 25 years, you'll have roughly $21,000. At 8%, that same $10,000 becomes about $68,000. That difference isn't small. It's life-changing. And the irony? Many people think they're being responsible by avoiding volatility. But volatility is not the same as loss. Temporary declines are not permanent destruction unless you panic. The real risk isn't short-term fluctuation. It's long-term stagnation. Another hidden danger of safe investments is liquidity traps. Some products lock your money for years with penalties for withdrawal. They promise stability but remove access. And when opportunity shows up, a business idea, a property deal, an investment downturn, you can't move. Safety that restricts movement can become a financial cage. There's also opportunity cost, the silent killer of conservative portfolios. While your capital sits safely, other assets grow. Markets expand, businesses innovate, equities compound. And by the time you feel ready to take risk again, prices are higher. Safety delayed growth. Now, here's what intelligent safety actually looks like. Layered protection, a fully funded emergency reserve, insurance against catastrophic events, low-risk funds for short-term needs, and growth-focused investments for long-term wealth. Safety isn't about avoiding risk. It's about managing it deliberately, because no investment is risk-free. Cash has inflation risk. Bonds have interest rate risk. Real estate has market and liquidity risk. Stocks have volatility risk. The goal isn't zero risk. It's balanced risk aligned with time horizon and purpose. If you're under 40 with stable income and decades ahead of you, being 100% in ultra-conservative assets may feel disciplined, but it could be the most expensive mistake you make. If you're near retirement, ignoring downside protection may be reckless. Context matters. Time matters. Allocation matters more than labels. And here's the final uncomfortable truth. Most people don't need safer investments. They need stronger emotional discipline, because what feels unsafe is often just unfamiliar, and what feels safe is often just comfortable. Before you label an investment safe, ask yourself, safe from what? Volatility? Inflation? Liquidity issues? Opportunity cost? Or safe for how long? 1 year? 5 years? 30 years? The biggest mistake isn't choosing conservative assets. It's choosing them blindly, without understanding the trade-offs, without aligning them with goals, without respecting inflation, without separating short-term protection from long-term growth. Safe investments aren't the enemy. Misusing them is. So don't make the mistake of protecting your money so aggressively that you prevent it from ever working for you. Because real financial security doesn't come from avoiding movement. It comes from building a strategy strong enough to survive it. And that's the difference between feeling safe and actually being secure. And once you understand that difference, everything changes. Because now the question isn't, what's the safest place to put my money? It becomes, what is this money supposed to do for me? Money without a defined role drifts toward comfort. Money with a defined mission moves with intention. If you don't define the purpose, fear will. And fear almost always chooses the lowest visible risk, even if that choice creates invisible long-term damage. Let's go deeper. There are two types of pain in investing: short-term volatility and long-term regret. Most people will do almost anything to avoid short-term volatility. They can't stand seeing numbers move down. They check balances too often. They react emotionally to headlines. So they retreat to safe territory. But 15 or 20 years later, a different pain shows up. Regret. Regret that their portfolio barely grew. Regret that retirement feels closer than expected. Regret that they now have to take more risk later to catch up. Volatility is loud. Regret is quiet until it's heavy. And here's what experienced investors understand. Time absorbs volatility, but time amplifies stagnation. If you have a long runway, temporary drops are speed bumps, not roadblocks. Markets recover, economies expand, innovation continues. But money parked in low-yield assets for decades doesn't suddenly accelerate. It crawls. Another hidden danger of playing it safe is inflation drift. Inflation doesn't hit like a crash. It erodes like water on stone. Groceries inch upward, education costs climb, healthcare expands, housing adjusts. You don't notice it week to week. But year to year, your lifestyle costs more. If your investments aren't growing faster than that rise, you're moving backward while feeling stable. That's the trap. Now let's talk about something even more uncomfortable: false diversification. Many people think they're diversified because they own multiple safe products. A savings account, a fixed deposit, a government bond, a conservative mutual fund, different names, same exposure, low growth, high inflation vulnerability. True diversification spreads across asset classes that behave differently over time, not just different versions of stability. And then there's behavior risk. The biggest financial losses rarely come from bad products. They come from bad reactions. Buying high during excitement, selling low during fear, freezing during opportunity. Ironically, People who overemphasize safety sometimes panic the most when markets move because they never built tolerance for fluctuation. If your entire strategy depends on markets never dipping, your strategy is fragile. Real strength is built by exposure, measured, intentional exposure to growth assets over time. Let's simplify this. There are only 3 real levers in investing: time, return, contribution. If you suppress return too aggressively in the name of safety, you must increase time or contribution to compensate. That means working longer, saving more aggressively, delaying goals. Most people don't calculate that trade-off. They just assume safe equals smart. But smart is contextual. A 2 8-year-old and a 6 2-year-old should not have the same definition of safety. Someone with stable income and low expenses has a different risk capacity than someone stretched thin. Risk tolerance is emotional. Risk capacity is mathematical. And confusing the two leads to costly decisions. Here's another angle most people miss. Cash feels powerful because it gives optionality, but too much idle cash becomes indecision. It's important to have liquidity. It's dangerous to let liquidity become permanent hesitation. At some point, money must be deployed to grow. Otherwise, you're just storing potential. Let's be clear again, this is not about reckless investing. It's not about chasing hype. It's not about day trading or gambling on speculation. It's about recognizing that long-term wealth requires exposure to productive assets, businesses, innovation, markets that create value over decades. History shows that disciplined, diversified equity exposure over long periods has outpaced inflation and built real wealth. Not in a straight line, but in a powerful upward trend over time. The mistake is expecting smoothness. Growth is rarely smooth, but neither is life. The people who build lasting wealth understand that temporary discomfort is the entry fee for long-term strength. They don't eliminate risk. They structure it. They keep emergency funds in safe vehicles. They insure against catastrophe. They invest consistently. They rebalance periodically. They avoid emotional extremes. And most importantly, they think in decades, not weeks. If you zoom out far enough, volatility shrinks. If you zoom in too closely, it dominates your perception. So ask yourself, are you optimizing for emotional comfort today or financial strength tomorrow? Because those two goals often conflict. The biggest mistake with safe investments isn't owning them. It's hiding in them. So before you move all your money into something labeled safe, pause. Define your timeline. Define your goals. Separate your money into roles.